Hi and welcome to Swissquote's Daily Market Talk. It's Wednesday, 12th of August. Investors are looking for direction amid the fluctuations that we see in the Middle East headlines and their impact on oil trading and corporate earnings as well. Today, the latest US CPI update could provide some short-term direction, some short-term clarity to investors, but the data per se won't capture the renewed surge in oil prices since weeks, leaving the Fed watchers with increasingly complicated inflation and rate outlook. Is it a problem though? We will talk about that and more. But before we do, and as always, please keep in mind that opinions are my own and this is not financial advice.
This show is brought to you by Swissquote.
So market sentiment is mixed. On one hand, oil prices fluctuate on every single headline. On the other hand, the technology stocks swing between hope and worries with the incoming quarterly reports from companies moving markets up one day and down the other. A good report from CoreView yesterday boosted technology appetite, and Korean Kospi index is up by around 4% at the time I'm talking this morning, but that optimism isn't really reflected in European futures this morning as higher energy prices are weighing heavier on today's mood just before the European Open. Now, speaking of that, yesterday, the rally in US crude paused for a minute after Pakistani defense minister said that they were getting close to some sort of arrangement. But alas, the relief remained short-lived after Iran added that the Strait of Hormuz will remain closed until the conditions that it demands from the US are met. Well, given the US conditions as well, both parties' demands from each other suggest that the problems won't be solved by tomorrow. Meanwhile, the situation in the oil reserves is getting tighter. The US strategic oil reserves continue to nosedive, and IMF warns that the actual crude oil prices don't reflect the severity of the oil supply shock today that the world is going through. Less demand, more oil production, and inventory drawdowns have actually prevented a larger price spike during this Middle East war, but buffers are running low, they say, leaving the world weaker when the next shock comes. This is what the IMF said on their latest blog post. And the disruption in terms of barrels that can sail through the Strait of Hormuz is actually very much notable because it now dwarfs every single supply shock that the world experienced, including 1970s oil shock, Iran revolution and wars, Gulf War, Iraq and Iran war, and Ukrainian war. And as I mentioned yesterday, crude oil market is back to backwardation today, meaning that spot prices are rising faster than the future prices, asking a premium from those who are willing to get oil immediately today due to the supply concerns regarding tomorrow. As such, the ongoing Middle East disruptions continue to pressure oil prices higher across the curve, and the deteriorating supply outlook will likely help oil extend its recent gains toward the $90 to $95 per barrel range for the US crude, and potentially up to $95 to $100 per barrel range for Brent oil. But of course, it's not an easy trade because everything can change in a blink of an eye. Any headline, found or not, does move the market very quickly, vanishing gains and clearing positions. Therefore, energy stocks are, in my opinion, a better alternative for those who are still willing to maintain an exposure to the ongoing energy crisis in the Middle East without necessarily taking the volatility in oil prices of the short term. Exxon and Chevron, for example, made around $26.5 billion in the second quarter alone amid the Middle East disruptions, while European oil majors earned around $24 billion combined in second quarter profit. And European majors have an extra weapon in their hands. They have big trading operations which actually allow them to profit not only from higher energy prices, but also from moving oil around the globe to take advantage of the geographical and price arbitrage opportunities. Indeed, SPDR's energy ETF has been outperforming the technology ETF since the start of this year, simply because it is quite an interesting hedge against both the technology sell-off due to AI worries building around the big technology companies and their massive AI spending plans, with somehow delayed returns on that investment, and also the Middle East war-led inflation risks. Speaking of inflation risks, all eyes are on the US CPI release due later today. Both headline and core inflation metrics in the US may have eased in the month of July thanks to a notable pullback in energy prices during the month of July, yet oil prices rebounded since then, and US gasoline prices, for example, which fell more than 16% between July and August, have already rebounded more than 13% since that August dip. Hence, today's US CPI print will give an idea on how fast inflation could fade when the Iran war is over and upside pressure in energy prices fade for good. But unfortunately, it won't tell us what the Fed should do next, as the next month's figures will again be tainted by a rebound in energy prices. On that matter, the EIA hiked its gasoline and diesel forecast for 2026 by 3.7% and 5.4% respectively, and also increases 2027 forecast for retail prices by 6.5%. And while besides energy, the significant rise that we see in chip prices due to AI demand is also expected to keep pressure on both consumer and producer prices, especially on electronics and their components. Morgan Stanley, for example, predicts that the chipflation could add 0.10 percentage point increase to headline CPI in the US and up to a 15 percentage point increase for PCs and smartphones. Looks high? Well, indeed, the annual change in electronic component prices is skyrocketing. It rose 27.6% in the month of June from the same time last year, and that was by far, and I'm saying by far, the largest increase on record since 1966. In comparison, this metric rose less than 20% at its peak during 1980s when PCs boomed, and around 5% during the pandemic disruption months, to say. So what I'm trying to say is that whatever the US CPI data says today, the upside risks on inflation won't fade in a blink of an eye. But if the numbers are softer than the ones that are penciled in by analysts, we might obviously well see a further rally in both bonds and stock prices, as the earnings season is going surprisingly well for the US and European companies, and that is obviously encouraging bulls to remain on the bullish side of the trade. The former, so the S&P 500 companies, are in path to print a 50% earnings growth in the second quarter, while the latter, the European, the stock 600 companies, are enjoying a 22% earnings growth despite the energy shock. And even though Europe's problems have only gotten worse with this summer's abnormally hot temperatures, drying rivers, and further disrupting transport within the continent, the earnings expectations for the stock 600 companies just keep rising. And many point that the European stocks are now at a very sweet spot because the European growth remains subdued, yes, but it is better than feared by analysts, but not enough to encourage a tighter European Central Bank policy either. Corporate earnings growth at the fastest pace in 4 years, though that number is of course skewed higher by energy and banks' outperformance in the second quarter amid volatile energy prices and also huge tech trades. And well, finally, the European bonds, the European sovereign bonds outperformed their US peers amid the US debt that is now spiraling out of control with the Middle East war and all the rumors that the US is failing to keep up with emissions, and the growingly opaque and unpredictable Fed policy, of course, as well. So the euro dollar returned to the highest levels in 2 months, not on the back of a hawkish ECB Fed divergence this time, but due to a renewed loss of appetite around the US treasuries and the US dollar as well. And dollar yen's rebound toward the 106 level is only adding fuel to the fire in terms of US treasury markets, as the weaker yen revives the worries of Japanese US treasury sales, which were actually very notable between April and May. So this is not just a rumor, it is really happening, and the latter adds further positive pressure on the US yields. So what happens next is anybody's guess, but it's worth noting that the markets around the world have been actually very, very resilient to the Middle East uncertainties, rising oil prices, the technology fatigue or questions around the big technologies, AI spending, the US fatigue with trade, geopolitical problems, and also the climate problems that have been very, very hard indeed for the Europeans. But alas, the bulls are dominating the markets today. Let's see if that positiveness lasts and for how long. So this is all for today. I'm İpek Özkardeşkaya, and thank you for joining me and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below as usual. Follow us on Instagram, on X, on LinkedIn, but also on WhatsApp, Threads, Telegram, and Blue Sky for regular market updates. Subscribe to our YouTube channel for daily market comments, and please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again tomorrow, and until then, good day trading.
Trading and investing carry risks, including capital loss. CFDs in digital assets are volatile and not suitable for everyone. Swissquote assumes no responsibility for accuracy or losses from its use. Products and services are offered only where legally permitted.